Today we're going to talk about the question that's on everyone's mind. Have we reached the bottom for risky assets such as Bitcoin, or are we headed lower from here? This video is my response to that question and why I think we will head lower in the intermediate term, and as such contains market commentary and opinions. This is not financial advice. It's just the opinion of some guy on the internet. So keep that in mind. Alright, so let's get started here. To really answer that question, we need to understand what happened in 2022, where we had the largest risk-off trade in the last 20 years, arguably. And that fundamentally changes the way we should be thinking about the market from back when I was last making videos in 2017 and 2018. See, back here, Bitcoin was only weakly correlated with other assets. And so I would sometimes take a step back and look at those other assets and compare it to Bitcoin, but it wasn't as fundamental to understanding whether you should or shouldn't buy into the asset class as a whole as it is now. See, now, if you look at this giant decline in Bitcoin, it is accompanied by all risk assets really declining in the last couple of months since the beginning of 2022. And so when we ask the question of where we think we're going next with Bitcoin, it's really important to understand what's happening with risk as a whole. Let's start our analysis of risky assets by looking at growth stocks. Morningstar likes to categorize mutual funds based on the stocks that they hold in their portfolio. And one of the characteristics that they look at is the spectrum of value to growth. Now on the left side here, we're looking at value stocks. These tend to be blue chip companies with steady profits, not a whole lot of surprises, don't require a lot of reinvestment, and they tend to pay out dividends. Growth stocks, on the other hand, tend not to pay out dividends or small dividends, and they reinvest heavily in order to maximize their revenue growth. The main focus of the company is growth, not profitability. Over the long term, the uncertainty with growth companies is whether or not they will be able to convert their business model to more of a cash cow style business. And so we like to say, typically, that growth stocks are riskier than value stocks. And in 2022, we've sort of seen that play out. So if we look at this equity style box performance provided by Morningstar, if you look at value mutual funds, they have seen single digit losses roughly across the board year to date for the first half. If you look at growth style mutual funds, they have seen over 30% declines across the board for the first half of 2022. However, this risk-off trade is not limited to just growth stocks. It doesn't just end here. Next up, I want to talk about what's happening in the lending market. Specifically, I want to look at the gap between the interest rate on high-risk loans and the interest rate on low-risk loans, also known as the spread. And that's what this graph shows you here. Now, the way that we discover the interest rate on high-risk loans is we look at the yield on junk bonds. These are corporations that are rated BB or lower by the credit rating agencies. The way we look at the interest rate on low risk loans is we look at the yields on treasuries. And these are actually no risk at all because the US government can just pay, or print money rather, in order to make those payments. Now, how much more do these corporations that have low credit ratings have to pay, or how much higher of an interest rate do they need to have in order to compensate you for the increased risk of defaulting on the loan? That is set by the market, and that is what the spread is in the first place. Now, we would expect that compensation to increase when uncertainty is high. And that's what happened here at the beginning. This huge spike here is the beginning of COVID. This is when the S&P 500 crashed by over 30% in just a couple of weeks. Over time, as we saw the recovery from COVID, we saw this spread decrease, which suggests that those investors in those high-risk loans didn't require as much additional return over the lower-risk loans. That suggests that we're in a risk-on environment. Basically, lenders are lending to anybody that they can, trying to get the most return possible, even if it means taking on higher risk. Well, over the last couple of months, really since the beginning of 2022, we have seen a steady increase in this spread between the interest rates on high-risk loans and low-risk loans. And we've seen a little bit of a reversal of that over the last 2 months, just like we've seen in most risk assets since June. but we're starting to see it tick up again, and I believe we're going to see this stay elevated for a long time. Now, the reason this matters is because it affects the cost of capital for higher risk companies. What type of companies do you think crypto startups are? We're going to come back to this a little bit later. But the other thing that has changed that's going to cause this to stay elevated, I think, for quite some time, is the interest rate environment. Most of you are likely familiar with the speech that Jerome Powell just gave at the recent Jackson Hole conference. I want to highlight one specific portion of that speech and what it means for risky assets such as Bitcoin and other cryptocurrencies.
Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation.
So how does this speech from Jerome Powell relate to risky assets such as Bitcoin? Well, the Federal Reserve has two main tools that it has used to support the economy over the last 15 years. The first tool is quantitative easing, or increases in the money supply, and that's what this chart shows. You can see that from the turn of the century, the money supply saw steady increases all the way up until 2008, where we saw a major increase in the money supply to support the Great Recession. And then we went back to more steady increases in the money supply again, all the way up until COVID-19. Now, when COVID-19 hit, the Federal Reserve and most central banks decided that they were going to support their economies no matter what. The Federal Reserve in particular bought a ton of mortgage-backed securities as well as treasuries in order to support the market. So we saw a huge increase in the money supply here. And even past this initial increase, as COVID progressed, the slope of the increase in the money supply was much higher than it was before. Now, over the last couple of months, we've seen the money supply completely flatten as a result of the Federal Reserve starting to tighten on its budget. And so they're letting the mortgage-backed securities, for example, lapse a lot more often. They're not buying as much of it as they were back during COVID. And so this is the first major pulling back we have seen from the Federal Reserve on one of its two main tools that it's used to prop up the economy. But this is not the only tool. The other major tool that the Federal Reserve has used is interest rates. Now, interest rates have been at their lowest level in modern history since the 2008 Great Recession. This has been one of the main ways that the Fed has supported the economy for the past 14 years. And what's interesting about what's occurring now is that the Fed is increasing rates at the fastest pace that we have seen over the past 20 years. So if you compare the slope of recent interest rate increases to those interest rate hike cycles that we've seen over the past 20 years, you will find that there is no cycle that has increased interest rates as quickly as we're seeing now. And this is why stagflation is such a real concern. Rising interest rates slows GDP, and we're already experiencing high inflation. So now I'm going to switch over to the Fed Watch tool, and you'll see that the market is forecasting short-term interest rates around 4% in 2023. Higher interest rates and higher credit spreads, like we discussed earlier, increases the cost of capital for companies, and it decreases the amount of available credit for riskier companies. And yet we haven't seen that liquidity concern substantially affect private equity, and this is where I suspect the greatest risk is to crypto in the intermediate term. What we're looking at here is venture capital deal activity in the United States over the last 5 years. What I want to show is that in 2022, yes, we have seen a decline in deal count. That is the orange line. Yes, we've seen a decline in deal value. That's the blue bars. However, when you compare it to historical levels, we're actually seeing that the deal activity is still quite large in 2022. And if we scroll down to the number of deals that are taking place, there's roughly 9,400 deals that have taken place in the first half of 2022 compared to 12.6K deals in the full year of 2020. So we're already at 75% the number of deals that happened in the full year of 2020. But the thing that's most interesting here that can kind of save this private equity market is that there's a lot of dry powder sitting on the sidelines here, and that's this left chart here. So What is dry capital or dry powder? This is just money that can be invested into new companies that's just sitting on the sidelines. It's waiting to get invested. And so this is part of what's isolated private equity from the movements that we have seen in the public markets. And this is even more highlighted if I show you what has happened in the IPO market or the exits market. So there's nothing that tells a clearer story than this. This information's from FactSet, and they put together a chart here that shows the number of IPOs and the amount of proceeds from those IPOs by year. And in 2021, we had 1,073 IPOs that raised approximately $300 billion, a little bit over that. If you come into 2022, year to date, for the first half of 2022, there's only been $9 billion raised through 92 IPOs. We've seen a huge decrease in SPAC activity, and in general, we're seeing a big disconnect between the private equity markets and the public equity markets. Why does that matter for you? It matters because so much of the crypto ecosystem is now supported by serious investment from venture capitalists. We've already seen a decline in funding for crypto startups in the first half of 2022, where we went from $12.5 billion in the first half of 2021 down to $9.3 billion in the first half of this year. And I think capital is going to dry up much more than this if the Fed continues to tighten. And I think they're going to keep tightening because they're already comparing what's happening now to the stagflation that happened in the 70s, where the Fed was punished for easing too early. The other question that's really important here is whether or not these really high levels of dry powder that these venture capitalist firms have, is that going to protect them from the tightening cycle that we're beginning to experience? And my opinion is that it won't, because I think the bigger issue here is that there's going to be a reluctance to deploy capital or invest in risky assets as a whole, rather than just simply a lack of capital. Although I think we're going to experience a little bit of that too as liquidity leaves the economy. And that brings me to the final conclusion of this video. Fundamentally, the point I'm trying to make is that, in my opinion, and I want to emphasize that it is just my opinion, the decision of whether to invest in Bitcoin and other cryptocurrencies depends on whether or not risk is currently overvalued or undervalued. This is not an easy question to answer because Bitcoin has already fallen from peak to valley 75% in 2022. You could easily argue that risk assets are now undervalued due to the 2022 crash. That would be the main bull argument right now. However, I think, even in spite of the massive declines that we had in 2022, that risk, and particularly crypto, is still overvalued. Bitcoin in the crypto market has already experienced bigger crashes than this without major financial tightening. The level of uncertainty that we're seeing right now in the greater investing climate makes this, in my opinion, a fundamentally different narrative for Bitcoin than the typical 4-year cycles that we've seen so far. Now, as for the time frame, we've been in a bear market for the last 8 to 9 months. Personally, I don't see it going past 24 months, given that the S&P 500 rarely sees more than 2 years of consecutive declines. And as such, I'm going to become increasingly bullish as time progresses, just due to the upward tendency of markets. Alternatively, if we saw Bitcoin, Ethereum, and other crypto, I would say, decrease around 40% from their current levels, that would obviously also make me quite bullish on them. Lastly, I want to say that I consider events like the merge to be blips in the bigger picture compared to this risk narrative that I've presented throughout this video. And that's why I didn't talk about it much here or other events that have happened specifically in crypto. Overall, I think it's going to be a lot of fun watching how the risk narrative plays out in this tightening cycle, and I look forward to watching it with all of you. I hope you all enjoyed this video. It's been a long time since I've made one, over 2 years since my last video and 4 years since I've last talked about cryptocurrencies. And, things are a lot more interesting, I think, now in the current market conditions. And so I have some things to actually say about what's going on. I know that most of the follower base that I had is pretty much gone now. But for those of you that stuck around, that are still here, I hope you enjoyed this content. I will be uploading more in the future. Anybody that's new, I hope you'll like, comment, and subscribe. And yeah, hope you guys enjoyed. See you next time.